Well, welcome to those of you joining us online. And we're going to finish up chapter 8 today. Specifically, we're going to be talking about materiality, which is the last part of the chapter. With materiality, it's not difficult material, but I have several illustrations I need to go through with you, so it does take a little bit of time. It's a very important topic. So let me go ahead and share my screen. And I will pull up the chapter 8 notes, the remainder of them. Roman numeral 3, materiality. So materiality, well, it often seems as though everything should be material, especially as we're in school. And I think in large part, that's because we're trained to answer accounting problems down to the penny. Well, we're expected to spend the amount of time to do so. So quite frankly, since we are, how much is our time valued here in undergraduate school, shall we say? Not. No, just take however long to solve the problem. But when you get out in the business world, well, time is money. And time is really expensive. If you're doing something like holding up financial statements, because you're an auditor trying to check out every single rule of the statement, you've really consumed a lot of money. People will be very upset with you. So in the business world, a lot of dollars can be considered immaterial. So if a misstatement is immaterial, we don't check it out in the audit. We don't pursue it. It's not big enough. On the other hand, if an item is material, we will check it out. We will pursue it. And if that misstatement that we find is material, we're going to require that it be corrected before we issue a clean opinion. Something is materially wrong. That means client can't get a clean opinion with material misstatement of their financial statements. But in the business world, it's amazing how many dollars can be immaterial. For example, if we have a corporation, a very large one with over $1 trillion in revenue, how material do you think a $1 million misstatement in revenue would be? Not.
That's not material.
Not material. No. Because it's too small of a percentage. We'll see some guidelines today for helping us decide how much material. We'll see in the end how much material is a matter of the auditor's judgment. But trust me, something less than 1/100th of 1%, which is what $1 million is out of 1 trillion, it's too small to drop in the bucket. It really is. Now, to us in our personal lives, $1 million is material, of course. We all love to win that in the lottery, for example. But in practice, not material for that very large corporation. So the auditor is not going to pursue it. Now, on the other hand, that's a much smaller company. And there is $1 million statement of revenue. Their revenue is $2 million. Wow, that's 50%. That's definitely material. So material is a relative concept. What's material to a small business is not going to be material to a large corporation. So the auditor would pursue it for the small business and require it be corrected before giving the client a clean opinion, but not for large business. But for a new auditor, it is very troubling to think about how much is material, because new auditors tend to think that everything's material, quite frankly. That's because they were brought up that way in school, where their time was assumed to be worth how much? Nothing. So we'll be developing some guidelines to help us decide, again, how much is material, how much is it? The specific dollar amount, how much is material and how much is it? Again, it's the auditor judgment. One auditor could judge it material, another auditor could judge it immaterial. But the key is to plan for one's decision to be able to justify that decision. And the materiality guidelines people set as part of the audit plan are going to help us do just that. You'll see how. And of course, document everything along the way. So let's see a few things here as we take a look. Here are the notes. Well, first, we know that an audit opinion states that financial statements are fairly stated in all material respects. Thus, there may be immaterial departures from GAAP and still have a clean opinion. There may still be immaterial scope limitations and still have a clean opinion. In fact, there will be so for virtually every client. We've seen this in financial accounting and B. An item is material if it can make a difference in a user's decisions. That's obviously a very major judgment call. And this chapter contains, again, some decision rules which will help make this easier. And most of these decision rules we'll see that the auditor leans toward conservatism. So as we have some guidelines or decision rules for helping us decide how much is material, well, the auditor will lean toward conservatism as we will see. So if in doubt, is this item material or immaterial? Material, yes. If in doubt, lean toward the conservative side. Make the conservative judgment call, it is material, therefore we will check it out and we will require it to be correct before we give that client a clean opinion. So let's see some steps in deciding materiality, which again must be documented in audit planning. So first of all, we'll determine a preliminary judgment as to total materiality in the financial statements. That's usually done by someone high on the audit team, such as the partner or the manager, someone with a lot of audit experience, so that they have the kind of built-in judgment call to make this decision. Someone with a lot of auditing experience, they realize how materiality differs from one company to another, depending on size, because they've audited so many times. A new auditor really would not be capable of making this decision. So we're looking for a grand total as to materiality here, and I will show you. Well, materiality is usually decided by comparing total misstatements against some monetary base or some benchmark, if you will. And I will show you on page 237. Just a second, but reading on just for now. Thus, materiality is relative instead of absolute. For example, a $100 misstatement may be material for a very small client, but clearly immaterial for a large client, because again, it's too small of a drop in the bucket. Thus, the auditor would pursue it for the small client, but not for the large client. So let's flip over to page 237 here in the book. Probably take me through my paces of signing in again. Yep. Yes, let's continue reading. Take me back to the previous page, even though I entered 237. And it finally decides to. Yep. Now let me input 237. No, it's quirks. So we're going to be looking at some written guidelines in just a moment. But I'd like for us to take a look here at this little table they have. And it's for the sample client that they have throughout the textbook, which is Hillsburg Hardware Company. I think I'm going to sneeze, which I hate doing in a mask. No, I guess I'm not. Okay. If I sneeze suddenly a little bit, you'll know why. That feeling comes back to me. Try and make it go away. Yeah, sneeze in a public place, and sometimes people might panic. They'll think you're a super spreader of COVID. Now, which reminds me, did you see the family of 4 that went to a Walgreens in Evansville, Indiana? I know which Walgreens it is too. I've never been in it, but anyway, they went to get flu shots. Mother, father, 2 children, 5 and 4. But they got a call a little bit later. The pharmacist gave them COVID vaccines by mistake. I'm sure they will. They have an attorney. Yeah. And the children, well, COVID vaccine is only supposed to be 16 and under, 12 and under in an emergency. And the children got 3 times the dose that is probably going to be recommended for child patients. So yeah, they both had terrible side effects. Oof, high fever, etc. High blood pressure. Ooh. So yeah, you can imagine that. And first, Walgreens didn't want to give them the vaccine cards. I mean, go through all that and not get the vaccine cards, please. Yeah, so if you get a flu shot this year, make sure it really is the flu vaccine. Or if you get a COVID booster, make sure it really is the COVID booster, etc. Kind of scary when we think about how we're at the mercy of healthcare professionals, so-called professionals in this case. So that was definitely a material error on Walgreens' part. Evansville. I used to have a student named Evan from Evansville. Don't know whatever happened to Evan. I think he's still here in town. Yeah, I never see him at services or anything. He's Jewish too, but I digress. Well, this Hillsburg Hardware Company, also in Indiana, up in Gary, and we've got here preliminary judgment about materiality rounded in thousands. Okay. They've got 4 different possible bases to judge materiality from, at least on a total level. Then we'll break this down account by account in a bit. Let's look at earnings from operations. They have a minimum figure and a maximum figure. Minimum of 3% or $221,000. Maximum of 6% or $442,000. We'll see where those percentages came from in just a bit. But those are fairly good rules of thumb out in business. So what this is really saying is, if we go through and we find total misstatements under $221,000, we will say those misstatements clearly are immaterial. If we find, oh, I'm sorry.
Is that like an exact threshold? Something that's $200,000.
I'll advertise. If we go through and we find total misstatements more than $442,000, we'll say those misstatements clearly are material and must be corrected, or that client gets clean opinion. On the other hand, if we find total misstatements between these $2 amounts, then we've got to think about it. The auditor's judgment really comes into play then. If this is a high-risk company, like an SEC company, once publicly traded, we're probably going to say material. If on the other hand, it's a small mom and pop company with no real risk factors, we'll probably say immaterial. So again, in the end, materiality is the auditor's judgment. They ask that very frequently on the CPA exam and on multiple choice questions, so you get that one right. Then current assets, same 3 and 6% figures. Total assets, 1 and 3%. For total assets, the percentages are normally less because total assets is such a big dollar amount. And current liabilities, same 3 and 6% figures. Now, if we were taking a look and really concentrating on one of these four, which one of the four would we concentrate on if we were being conservative? Judge it from the dollars. Percentages, you're right, Mary. The judging from the dollars, which one would be the most conservative of the four bases? Bless you. Good, maybe you sneezed for me. Learning some operations, that's right. Lowest amount of dollars, that's what. In fact, this all is going to, in their judgment, take that figure and run through the rest of the example here in the chapter. Where do those numbers come? There we go. So, these judgments about materiality came from the CPA firm's own policies and procedures manual. On any other business, they should have that. So, here we've got illustrated materiality guidelines. And these have been prepared using PPC software. If your CPA firm does not have the policies and procedures manual, there are model ones that you can access and use the support to build your own. So they use it from PPC software. That's why there's a lot of common ground out there. So we've got some common ground here. So we're going to get these CPAs up here. We see the policy statements here. And it says that professional judgment is to be used at all times and setting applying materiality guidelines. As a general guideline, policies will be applied. Well, first, the combined total of statements in the financial statements exceeding 6% is normally considered material. Okay, that's exactly what we saw. A combined total of less than 3% is presumed to be immaterial in the absence of qualitative factors. Those are things we studied before, like fraud or related party transactions, or debt covenants are then tight. While combined statements between 3% and 6% require the greatest amount of professional judgment to determine their materiality. So that's where we think about it. So number two, the 3% to 6% must be measured in relation to the appropriate benchmark. Many times there's more than one benchmark to which the statement should be compared. And the following guides are recommended in selecting the appropriate benchmark. We just saw them in numbers. The income statement. Well, combine the statements in the income statement should ordinarily be measured 3% to 6% of operating income before taxes, just like we said. A guideline 3% to 6% would be inappropriate here, which income is unusually large or small. An operating income in a given year is not considered representative. The desirable substitute benchmark a more representative income measure. For example, average operating income for a 3-year period may use the benchmark. So we can certainly do that. Sorry, this computer fan's a little bit noisy today. Now we'll see. Herein on the balance sheet. Well, combined with statements in the balance sheet should originally be evaluated for current assets, current liabilities, and total assets. For current assets and current liabilities, the guideline should be between 3 and 6%, applying the same rules for the income statement. And it was. And for total assets, the guidelines should be between 1% and 3%, applied in the same rules for the income statement, because again, total assets is just a great big dollar figure. Number 3, qualitative factors, again like fraudulent transactions, or illegal party transactions, or when debt covenants are being tight. They should be carefully evaluated on all levels. In many instances, they're more important than the guidelines applied to the income statement and balance sheet. The intended uses of financial statements and the nature of the information in the statements including footnotes must be carefully evaluated. So again, in the end, materiality judgments are always up to the auditor's professional judgment. So that's where the numbers came from in these guidelines. The questions so far. They can change. So another auditor can have different percentages. These are quite common percentages in practice. So widely accepted shall be said. And again, build in to reduce the uncertainty. So yeah, the CPA firm would not need to use them. They could use other percentages if they would like to. But it's pretty basic. But the main thing is, you can see, you have to justify your decision. You have to justify why you do it. And these guidelines here allow justification. You bet. Other questions so far? Of course. These judgments are made by the partner audit manager. So someone with a lot of audit experience. So they have a gut feeling for that. A new auditor would not be expected to do this. Instead, the new auditor is going to get a lot of work that doesn't involve tremendous amount as they learn this. And then as they get more and more auditor experience, they'll develop more and more professional. It's a lot to be responsible for. That's right. And for new auditor, just advice. Definitely advice. Easy. I bet the parent organization is the chapters. Yeah, the national. Because not-for-profits, and unless they're really small, they usually are required to be audited. When you get excuse me, federal or state funds to manually or to maintain the 501 status, like 501c3, which is the subchapter of internal revenue code that most not-for-profits are into. They want to. So Florida Southern, we're a 501c3, and we're required to have an audit, not only to maintain that status, but also because we require state funding, and also because we have loans, we have bonds, privately issued bonds. Donors also expect an audit, because if they don't see an audit report, they're going to think, ooh, well, yeah, what's happening to our money? Yes, precisely. So we must have it. But not-for-profits of any size are going then right. Yeah. So for example, our Beta Outside chapter here, we have to file financial reports, etc. Our chapter's not on it, but the national level, Beta Outside is. Now the auditor could ask to audit documentation for our local chapter. I don't know whether they do that random. I know with the Florida Institute of CPAs, their auditors do audit chapters randomly. And while I was chapter treasurer years ago, my chapter got audited, so I had to prepare all the documentation. But the headquarters in Tallahassee is audited every year. But then a sample of some chapters are audited each year. But turned out to be about once every 3 years per chapter. That's right. So with Beta Alpha Psi, I hope we don't get audited. Not that we do anything wrong here, we don't, but still, it's a pain to have to prepare all the documentation for it. Leave that narrative. Anything else so far? All righty. Well, you know, we said those qualitative factors are really, really important. So looking at B there, we can remember that some items are material due to their nature, the qualitative factors again. No matter how few dollars are involved, that was that list on page 62. Again, things like related party transactions, transactions which are illegal or fraudulent, when debt covenants are getting tight, etc. Well, thus the auditor will virtually always check these out and require any misstatements to be corrected, even if very, very small. So we pull them out separately. We don't throw them in the pot with these 3% and 6% figures. Now, we're going to be taking the dollar of one of the dollar amounts that we focus on as an auditor in our judgment, and we will break it down account by account. So we'll focus on one big total preliminary judgment about materiality, break that down account by account. That's going to be our mission next. So in number 2, we'll determine performance materiality, which is a tolerable misstatement of each segment or account. This means the auditor will allocate the total preliminary judgment that we just saw to each segment or account. I'll show you an example on page 240. So in this example, here's how this auditor is focused. Again, it's up to the individual auditor. In this example, the auditor decided to tolerate a maximum of $442,000. That's that 6% figure from earnings from operations. Tolerate that much of misstatements and debits and tolerate a maximum of that amount of misstatements and credits, or double that, $884,000 in total. He or she is then going to allocate this $884,000 to the real or balance sheet accounts. Well, with focusing on that 6% figure, the high figure, and with doubling it, I would say this is a very low risk client. Otherwise, the auditor would not have been this generous. Now, again, another auditor may have said, I'm not going to double it. I'm going to go with 1.5. That's okay. Or yeah, another auditor might say, I'm not going to multiply it at all. I'm just going to take 442,000 and allocate it to the balance sheet accounts. All perfectly valid, as long as they justify and defend that decision in their audit documentation. You know, the smaller this total, the less misstatement we tolerate. So the smaller that total, the more audit work we're going to have to do. So the more precise that audit's going to be, shall we say. So as I have a little note there, smaller that total amount is, the more work we're going to have to do to really get the bugs out. And a few little notes on that. Materiality is often allocated only to the real accounts, as the nominal accounts are also affected due to double entry accounting. So again, those real accounts carry over the next year, and we concentrate our audit efforts on them. We really do. Starting point of the audit. So we'll now go through the example in the book. And as we do, we're going to see how heavily the auditor's individual judgment will come into play. And let me just take a look a little bit more here before I go to page 240. Well, in B, we're going to pay special attention to the reasons why more or less tolerable misstatement may be allocated to a particular account. This example is going to walk us through that. And C, the smaller the tolerable misstatement relative to the book value of an account, the more evidence will have to be gathered, and the more precise the evidence must be. I think that makes sense because, again, the smaller the materiality that we will tolerate, the more audit work we must do. We must be much more precise. And let me look at the first little notes here. Thus, an auditor will assign a small tolerable misstatement if he or she plans to gather much evidence about the account using a very precise auditing procedure. And this allows the account balance to be stated at a very precise amount and thus contain relatively low misstatement. So with that in mind, let's go to that example on page 240 of the book. There we go, figure 8.7. Performance materiality levels or tolerable misstatement levels for Hillsburg Hardware Company. First of all, we have some balances as of December 31st, the client's fiscal year end. Those are the client's book values or unaudited values. So these are the amounts this client asserts are correct for each of these accounts. Of course, being an auditor, we're professionally skeptical. We don't fully believe those until we gather evidence to back them up. And that's where our audit comes in. So in the next column, we've got performance materiality or tolerable misstatement, as we usually say, actually, in thousands. We'll see some little notes here, A, B, C, etc., down at the bottom, as to why we allocated a small or large amount of materiality to each account. Let's start with cash. First of all, when it comes to cash, first thing on the balance sheet, how precisely would an auditor want this to be stated anyway? Very precisely. Yeah, first thing on the balance sheet, most liquid asset to be embezzled. A lot of transactions go into it. Each one of them can have an error in it. And so cash is prone to a lot of things going wrong with it. But first thing on the balance sheet, most liquid asset, yes, let's have it stated very precisely. So this balance of $828,000, performance materiality or tolerable misstatement allocated is only $6,000. What we're saying is that if we go through and we audit cash and we come up with an audited value within $6,000 of the client's book value, we'll say cash is fairly stated. Nothing else needs to be done to it. So if we get an audited value for cash of $822,000 to $834,000, we'll say cash is fairly stated. Say that's the 6% range. Outside that range, we'll say cash is not fairly stated and must be corrected before we give the client a clean opinion. But that $6,000, that sure is not much out of $828,000. Let's see why in Note A. It says small performance materiality or tolerable misstatement because the account can be completely audited at low cost and no misstatements are expected. In the second auditing course, we'll get into auditing cash, but we can audit very precisely. We can count any currency the client has on hand and confirm any cash on deposit with the bank. So we can audit it very completely, very easily at low cost. And plus, we want to do that anyway, because we want cash to be very fairly stated. So we're not going to waste much of our total $884,000 of tolerable misstatement on it. Now again, twice the $442,000 amount. So we'll save those dollars for other accounts, as we'll see. Let's see some other Note A's here. We've got one beside notes payable total, a balance of $28.3 million, only $6,000 of tolerable misstatement allocated to it. They're going to audit it very completely at low cost. My guess is that this client has a few large notes payable. This auditor is going to confirm them all. So we'll know the balance very precisely. Accrued interest and dividends payable has a Note A as well. My guess is the auditor is going to recalculate all this. So again, we'll know the true balance or fairly stated balance, I should say, very precisely. And finally, capital stock and capital in excess of par. Well, we can find out the exact amount quite easily based on stock issuance. Also, if they have issued no additional stock this year, the audited figure last year is going to be the same this year. No changes. Any questions there so far? Now, I'm not interested in the exact amount of dollars that this auditor is assigned to tolerable misstatement in that right-hand column. Another auditor would assign different amounts of dollars. But again, it's a judgment call on the part of the auditor. But I want you to see the overall pattern of what's going on and tell the story of why more or less tolerable statements out. Does that make sense? Let me come back to the notes and take a look at the second little note I skipped over for the time being. It's the converse of what we just saw. Little Roman numeral 2. Conversely, an auditor will assign a higher tolerable statement if he or she plans to use relatively imprecise auditing procedures or to gather less evidence. And this allows for a greater margin for the ballpark figure which is obtained. A good example of such procedures are analytical procedures and sampling. Of course, proper account balance will not be known with a great degree of precision. And this allows for relatively greater misstatements to remain incorrect. So reading between the lines, we have to be willing to live with those relatively greater misstatements. So let's see an example of that if we look at trade accounts receivable next. Trade accounts receivable means business-to-business receivables. And that means after deducting the allowance for bad debts. The balance of almost $19 million. They've allocated $265,000 of tolerable misstatement to it. That's a big chunk of this total that they have to allocate. They have to leave for $1,000. Let's see why in Note B. So in Note B, large performance materiality because it knows large. That's one reason. Book value is big and requires extensive sampling to audit the accounts. So extensive sampling. They have a lot of accounts receivable. I can read between the lines. They're going to confirm a sample of it. Sampling does not give us an exact figure. So they have to be willing to live with the ballpark figure. So they have to be a little bit more imprecise here. Then they go through the same thing with inventory. So balance almost $30 million. Again, $265,000 allocated to it, a large amount. And with inventory, reading between the lines here, they're going to count sample some inventory items. Again, sampling doesn't give us a very precise figure. So we've got to allow a large margin of error here. So with that, we've used up way over half of our total amount of $884,000 just between those two accounts. And another note these. Let's take a look at Note C. Other current assets. Almost $1.4 million book value, $60,000 of tolerable misstatement allocated to it. Let's see why in Note C. Large performance materiality or tolerable misstatement is a percentage of the account, should be percentage by the way, because the account can be verified at extremely low cost, probably with analytical procedures. Saying substantive analytical procedures is redundant, as we know. All analytical procedures are substantive because they deal with dollar. That's like saying ink pen or pin number or tuna fish or codfish. All those things are redundant. Thinking about it, redundant things like that. Let's see some other Note C's here. We've got a Note C by accrued payroll and payroll tax. Same story. And beside other liabilities, again, the same story. Now, let's come up to property, plant, and equipment. The balance of over $10 million. $48,000 of tolerable statement allocated to it. That's not a very big chunk of its account balance. Let's see why in Note D. Small performance materiality or tolerable statements percentage of the account balance Because most of the balance in land and buildings, which is unchanged from the prior year, not beyond the total of this year because we already know the balance. So that relatively small amount of tolerable misstatement here, 48,000, will allow for things like purchases of property plant equipment, little errors in it, or sales of property plant equipment, or other disposals, or errors in calculating depreciation. So no D we have. We have a no D. Beside trade accounts payable, that means business to business. Balance of $4.7 million, $90,000 of tolerable statement allocated to it. So let's see why and notes A. It says moderately large performance materiality because a relatively large number of misstatements are expected. Now that sounds great at first blush, but reading between the lines, the auditor is willing to live with these misstatements. For accounts payable, of course, the client motivation is to understate payments. So my guess is that these misstatements are suspected to be overstatements. The auditor's willing to do it. If they were suspected to be understatements, the auditor would not be willing to do it. In fact, might decrease that materiality. So they would have to be corrected. Here. And for everything except retained earnings. Not applicable and noted. And if they're in fact, it's not applicable because retained earnings is a residual account. Is affected by the net amount in the statements in the other accounts. And that is very true because as it turns out, well, it's simply an account which has been netted. It's a difference and we don't have to assign any tolerable misstatement to it. That's good. So again, I'm not concerned about the exact dollar amounts that this auditor has assigned here for materiality, but I'm concerned that you understand the overall pattern, the overall story, the reasons behind why more or less tolerable misstatement was allocated to each. So does that make sense? Okay, good. That's what you would be expected to know on the CPA exam as well. Let's come back here to the handout and look at note D. Sometimes tolerable misstatement will differ for understatements and for overstatements for a particular account. For example, the auditor may allocate less tolerable misstatement for overstatements than for understatements of assets and revenues, because think about client motivation. They're motivated to overstate these, not understate. So as an auditor, we don't want them overstated by much, but if they're understated, it's kind of like, well, maybe that's a little bit of built-in insurance, at least up to a point. Well, conversely, this auditor may allocate greater tolerable misstatement for overstatements than for understatements of liabilities and expenses. Because again, the client motivation is to understate liabilities and expenses, not overstate them. Again, all that has to do with the client's bias. That will pop up in one of your homework problems. Now, what's left? We'll perform the audit test and estimate the maximum total misstatement in each account. And the auditor is going to have to consider sampling error, and I'll show you. And then we'll compare the maximum total misstatement to tolerable misstatement. Again, I will show you. Let me go over to page 242 to do so. Sorry about that direct projection thing right there. Don't worry about it. So here's table 8.2. Illustration of comparison of estimated total misstatement to preliminary judgment about materiality. we've got 3 current asset accounts here. Now, this is for a different client because the dollar amounts are different. I don't know why they didn't stick the Hillsburg Hardware Company, but oh well. So we have performance materiality for each account. We have known misstatement and direct projection, I will explain. We have an allowance for sampling risk, again, I will explain. And a total amount, which I will explain as well. So first of all, with cash, this auditor said, performance materiality or tolerable misstatement, I will tolerate up to $4,000 of misstatement in cash and still say cash is fairly stated. They go through and they audit cash. Here's how much misstatement they find. They find $2,000. I will assume that's an overstatement. An understatement would have a negative sign in front of it. They've audited cash very completely. They did not sample. They will have no sampling risk as we go with the next 2. So the total amount of misstatement in cash is $2,000. Would you say cash is or is not fairly stated? Stated. Is cash fairly stated? It was fairly stated, yes. Because $2,000 is way under that maximum $4,000 that we were willing to tolerate. Good. So cash requires no further action before the client gets clean home. It's okay. Now let's look at accounts receivable. Performance materiality or total misstatement of $20,000. Then known misstatement and direct projection is $12,000. Again, I will explain, along with the allowance for sampling risk and the total. They could have done a much better job of explaining this in sales, but they didn't. So let me illustrate this for you at pure moment. Does anyone not have this? Yeah, because in the business school, we have a little gap of where statistics are connected. But I can show you this very, very easily. In statistics, if you have something you do not really it gives us something obvious. So again, for cash agency, so we don't want to what we do is we see the accounts receivable are having a misstatement of $12,000. Again, I will assume the statement. With accounts receivable, that's client bias. Plus, a lot of clients don't always write off uncollectible accounts receivable. So they're often overstated. Now, what this auditor would do in sampling, as in sampling and anything else, is that the auditor would take that $12,000 one nice magic mark. Let's see. Mark here. You can do it. Thank you. And then this marker's not going to do too well. Good. Okay, so this sample, okay, what counts received as set error of this statement, $12,000, and accounts received. Oh, and for those of you online, I'm sorry, let me stop sharing the screen here. Okay, there we go. $6.86. If we took another sample, we could get something a little bit different from 12,000, even higher frequency. The only way that we know the true amount of student population is if we sampled what? Everything. That's sure would get to be expensive. So instead, again, sample gives us only an estimate. Really, that's ballpark figure. This $12,000 or sometimes not very simple. It is our best estimate of the true population value, which is signified by the Greek letter mu. So we need to turn down the state of the population. That would be, again, only knows that if we sample everything. Instead, our best estimate is what's in the sample. Which is expert. Or impacts. One good thing so-called central limit theorem tells us with lower down statistics is if we take repeated samples from a population, those X bars, or E hats, or sample means from these repeated samples will form a normal distribution. It's a nice bell-shaped curve. So we can draw a bell-shaped curve right around this $12,000. That's not very simple. Think about how far you might be away from this sample mean. So how far away from the sample the true population value might be? We have a formula to do that in statistics with the standard deviation of the sample, the amount of variability in the sample, in other words. Well, our book was lazy. They just took half of 12,000 and said, there's our allowance for sample. Don't worry. So they took 6,000 and added and subtracted that from 12,000. They came up with a low of 6,000, even though they didn't show it to us, and came up with a high of 18,000. That 6,000 would be the least amount of error we would expect in the population. The least value mu probably is. We tend to call that the lower confidence limit. That's the lower confidence limit. 18,000 is the maximum amount of error we think is in the population. How high you might be in there. That's the upper confidence limit. And this whole schmear is called a confidence limit. It's called a confidence interval. And here in a moment. So in the book, they only showed us this maximum amount of error, upper confidence limit. Again, they were lazy. The really important thing is compare this to that precision materiality or tolerable misstatement of 20,000. That 20,000 says that the auditor will accept understatements of up to 20,000. That would be someplace down here. Or this auditor will accept overstatements of up to 20,000 as well. Again, that's tolerable misstatement or performance materiality. So willing to accept understatements up to 20,000. Overstatements up to 20,000. What would our conclusion be with accounts receivable? Is it fairly stated or not fairly stated? Fairly stated, you bet. The reason is that both the upper and lower confidence limits fall within the bounds of tolerable mistakes. So we're well within 20,000 bucks. With the upper tail, well, $2,000 margin right there, that's okay. So accounts receivable, which this is fairly stated. Any questions about that? That's one line here on green. That's not good either. I think I've got a working black marker in my office. Let me go in my office. I'll be right back.
That's pretty good. I did, yeah. I thought we were doing it too.
All right. Quickly line here, this black marker, oh, good. Yep. So let's go back here to the book. Let me share my screen with you if you're online. Let's look at inventory. Performance materiality, also known as tolerable misstatement, is 36,000. Known misstatement and direct projection, 315. Looks like we're already in trouble. And sure enough, the allowance for sampling risk, 15,750. Again, they were lazy and they took half, but theoretically, this is the standard deviation sample multiplied by a z-score. If you're never looking them up in statistics, I'm not concerned that you know that nitty gritty, but I'm just concerned that you can make judgments here. Anyway, the total of 47,250. Let me go ahead and illustrate that up on the board in a confidence interval. So with inventory, they have not counted all inventory. Instead, they count samples. That's a lot cheaper, but you only get the ballpark figure once again, but the same. The same. If they counted everything, they would know the exact amount in the statement and inventory. Or something pretty close to it at least. So here with inventory, as I draw a confidence interval, and for those of you online, let me stop sharing my screen. Again, I would take a line here. I would put this sample mean sample projection in the middle, which was 31.5. Check that. So X bar or E hat. I would reflect that that is the sample mean. It's our best estimate of mu, the true population value, which we would only know if we sampled everything. So mu might be a little bit more, might be a little bit less. How much more, how much less? We can project that with the bell curve. Nice symmetrical normal distribution that is. They calculated the allowance for sampling risk is 15,750. That's how much the mu might differ. Giving us a lower confidence limit of 15,750 and an upper confidence limit of $47,250. So sampling gives us a range again. Here's the least amount of error. We expect the population $15,750. Here's the maximum amount of error we expect the population, $47,250. And they concentrated on the maximum, obviously. Although this confidence interval could span 0, they didn't show us one, that's okay. But the really important thing is compare that to tolerable misstatement. So tolerable misstatement, once again, was 36,000. So with tolerable misstatement, adjust my camera. We're willing to tolerate understatements of up to 36,000. I'll put maybe 36 there. Or overstatements of up to 36,000. Overstatements like a positive 46,000. So there we've graphed out tolerable misstatements. What is our conclusion about inventory? Is it fairly stated or not fairly stated? Not fairly stated. The upper tail is the problem. Because there's potentially too much overstatement. Now, in the exam, my exam, the CP exam, you won't have to look at confidence intervals or draw them out. I just need to do that to illustrate what was going on. Any questions there so far? Just make sure we have that confidence. And again, inventory is not fairly stated. Let me share my screen again. And so back here to table 8.2. They were not very good auditors. They have preliminary judgment about materiality at 50. Well, add this column up. It adds up 60. Yeah, I don't get that. Okay, again, they just look good auditors. Okay, this one adds up okay. This one is off. It should be $21,750. This one's off. It should be $67,250. But then they try to explain in the book why these numbers don't add up, and it makes absolutely no sense. These numbers have not added up addition after addition. So instead of simply correcting the numbers, they engage in a lengthy discussion against why they don't add up. It reminds me of a politician, not admitting to their errors, but instead trying to explain them away. All right, coming back to the notes. Well, dealing with the rest of number 4, we've already compared the maximum total misstatement to tolerable misstatement. And again, that account is fairly stated if maximum total misstatement is less than or equal to tolerable misstatement. But the maximum total misstatement is greater, as with inventory, the client should correct the account. That's the best thing. Or in parentheses, these things are sometimes mentioned that the auditor could do. The auditor may apply additional auditing procedures like counting more inventory items in hope of getting another misstatement, which is less than or equal to tolerable misstatement. That's usually not good. We usually just get more of the same old misstated stuff. Or even change tolerable misstatement. Now that doesn't sound very good. It's like we're fishing for the results we want. Otherwise, the auditor is going to have to conclude the account is not fairly stated. The auditor will have to say, well, client, you've got to correct this account before we can give you a clean opinion. And that takes care of everything in chapter 8. So any questions there on chapter 8? Okay. Certainly, Carter. Oh, I will extend that. Okay. Sorry about that. So chapter 9 homework says in syllabus due October 20th, I will extend it. Yes. Okay, at least on my lab, signed the 20th. Yeah, well, I will correct my lab and you can always go off the my lab dates. You bet. Yeah, we haven't been over chapter 9 at all yet. What other questions do you have? Well, again, as you know, to help compensate for test time, we won't have class on Wednesday. So try to finish up your exam when you have a chance. And other than that, I won't see you back until after fall break. So have a great fall break. And I'll see you back the Monday after we get back. Okay. Bye-bye.